Good morning and good evening, depending where you are. Hi, Jim and Zhiguo. I guess it's good evening for you and good morning for participants in China. Welcome to the inaugurating event of the China Biweekly Seminar on Public Economics. And this seminar is jointly organized by the National Institute for Fiscal Studies at Tsinghua University and the School of Economics and Management at Tsinghua University. And we also, I'm also glad that the Tsinghua Chicago Joint Center for Economics and Finance and the Becker Friedman Institute China are joining us together to organize this series of seminars. And the Institute for Fiscal Studies at Tsinghua University has been organizing other events to help promote research in public finance. In the past, we organized conferences, and in the last 2 summers, we organized summer schools for participants from China and from overseas. And in all these events, we benefited a lot from our colleagues from other countries. And we are very grateful for their effort in helping promoting the research in public economics in China. And this time, partly because of COVID-19, we cannot conduct seminars face-to-face in person. But fortunately, we have these online platforms available to help us to conduct seminars online. And it's, to some extent, this is a good thing because it's easier to invite speakers, but still the speakers are putting in a lot of effort into this. Thanks very much to the speakers who have agreed to present their work here. I very much hope that the series of presentations will benefit researchers everywhere. And thanks to Jim. Thanks very much to Jim for agreeing to give the first of the series of presentations at the China Biweekly Seminar on Public Finance. And thanks to Zhiguo for leading the effort of Becker Friedman China to jointly organize these events. I believe that these events will be very productive. Everyone will benefit a lot from this. And without further ado, I will give normally we say the floor, now give the platform to Binzhen and later to Jim. Thanks.
Thank you, Professor Bai. So I'm supposed to introduce James Poterba formally, but before I do that, I want to tell you some tidbit. So yesterday, our staff gave a short biography about James, and it's like 1 full page, which I need to read for more than 5 minutes. So I try to shorten it, but it's very difficult because there are all many important titles and important positions and awards. So I decided to just give your CV to the audience in our WeChat group and ask them to read the more details. And today I only highlight the information that I think very important. So Professor James Pederberg is the Mitsui Professor of Economics at MIT and the president of MBER now. I know it's a lot of work, huh? He has served as the vice president of the American Economic Association, a director of the American Finance Association, and the president of the National Tax Association. He's a member of the National Academy of Science and a fellow of the American Academy of Art and Science and of the Econometric Society. He served as a member of the President's Advisory Panel on Federal Tax Reform in 2005. So James' early research focused on how taxation affects the economic decisions of the household and the firms. I'm sure that many of the audience have read your paper on this topic. And his recent research focused on the determinants of retirement savings and the role of the tax-deferred retirement saving programs, which China is also considering. He's a former editor or co-editor or associate editor of quite a few journals, including Journal of Public Economics, Rand Journal of Economics, Review of Economics and Statistics, and the Journal of Finance. Because of all his contributions, he received the Daniel Holland Medal from the National Tax Association in 2014. One more thing I want to highlight about James is that he has been very, very supportive to the US and China collaborations on research and academia activities. I think in the recent 10 years, he visited China almost every year, right? There's a joint conference, there are several joint conferences between MBER and the Chinese institutions. And he also attended Tsinghua's first conference on public economics in 2011. And that's the first time I personally get to know James. And James was not my discussant, was not the discussant of my paper at that time, but he surprised me by giving me a lot of comments of my paper. He was so kind. And also for this seminar series, Jane is the first professor says yes to our invitation. So I'm so grateful to James to support our activity. Okay, now I'll give the floor to James. James?
Bin-Chen, thank you for that wonderful, too long but embarrassing introduction. I must say I am deeply honored by the opportunity to serve as the inaugural speaker in this seminar series. I have many happy memories, not just of my visit to Tsinghua in 2011, but of happy visits to the Haidian district of Beijing. I'm sure I somewhat mispronounce it, but at Beida, at Tsinghua, and also more recently, as the NBER has launched a partnership in Shanghai with the Shanghai Advanced Institute of Finance. One of the reasons I was so pleased to receive this invitation was that I was very disappointed earlier this year when we needed to cancel on account of the global health circumstances, a conference that I had hoped to co-organize on the Chinese housing market and mortgage market at the end of June in Shanghai. And I very much look forward to returning to SAFE in the spring of 2021 and to returning to Beijing for a joint conference there in 2022, and hopefully seeing many of you at that time. It is really wonderful to see a number of people, including Dean Chong and Bai, on the call this morning, who are very long-term friends and fellow travelers in the public finance area. And it's exciting to be able to share this time via this wonderful international platform with you. What I would like to discuss this evening for me and this morning for you, is one of the most important sets of issues in public finance facing both China and the United States in coming decades. And I'm going to try to, at this point, share my screen and see if this will all work. I hope you're now seeing a slide on retirement security in a low return environment. And before I show you anything else, I want to just say that what I'm going to try to connect for you this morning is the developments that are taking place in global financial markets, where we now are seeing, at least in the West, really historically low rates of return on government bonds, and also it seems low expectations of returns on more risky assets. I want to connect that with the public sector's role and the private sector's role in providing retirement security. And as I do that, I'm going to sketch some of these interactions for you. I hope this will be, and I recognize I'm going to largely focus on the North American experience with retirement security programs in the public and the private sector. But I'm very eager to learn, when we have time for some questions, about the translation of this to the Chinese circumstance. So, I begin with the observation that this issue around retirement security is first order, not just in the US, but also in China, and maybe even more important in China than in the US. What I've started with here are some statistics on the fraction of the population over 65 and over 80 in China and the United States, as well as Western Europe. As most of you will know, China at the moment has fewer old people than the United States, at least as a percentage, but the rate of increase is faster. And by the middle of this century, China will have a significantly older population than the US, although not quite as old as Western Europe. And that reflects the dramatic decline in birth rates which have taken place. Western Europe falling very rapidly, as well as China, the US not quite as fast. So I'm not going to discuss demography, although it's a fascinating subject and I wish we could, but I set the stage by saying that as a public finance economist, thinking about the policy environment that affects the older population is clearly a topic that will be with us for a very long time into the future. Okay? The second observation to start us off is that there are traditionally three different pillars of retirement security. The core government provided pension, what we would call Social Security in the United States, employer provided programs of various kinds. In China, the enterprise and the occupational annuities would fall into this pillar. And then the voluntary individual retirement saving, often accompanied by some tax incentives to encourage that type of behavior on individuals' parts, which at the moment is just beginning to be part of the story for China, but is much more important for the US setting. And I hope what I can show a bit of this morning is how the US has evolved and how some of these developments in capital markets impact particularly the employer provided and the voluntary individual aspects of the pillars for retirement security. Okay, so let me, to take us to the Chinese context for just a moment, the Society of Actuaries, which is a US-based institution, has been doing for several years a survey of Chinese households, asking them about their views on retirement security. And the results suggest that not only for public finance economists, but for Chinese households, concerns about retirement security are actually first order, right? That roughly 2/3 of the households in Beijing and Shanghai in the survey did not expect to be able to live their desired lifestyle in retirement. And in many of the other and less rich provinces, those fractions were even higher in this recent survey. The proposition, I have enough savings to last until the end of my retirement, commands an affirmative answer from only about half of the population in both of those large metropolitan areas. And then the question, what is the government's role? 40% of the population surveyed indicated that the government's funding for the aging population was a major concern. almost half of the population said minor concern, and as you can see, only 11% of the population did not think that this was a very important issue for China going forward. Okay, now, to just set the stage for where China's current structure is, I take a slide from Hanming Fang's and his co-authors' very interesting paper on the Chinese pension system, which is in the Chinese Handbook of Finance, and it basically shows us the relative importance in terms of the total expenditure on the different pillars that I have just described. Right? So effectively for China, the basic old age insurance, which is the government first pillar, is almost everything at the moment. Okay, with the enterprise annuities making up a very small part, and then commercial annuity insurance, which might be purchased by someone as a result of their saving in a voluntary account, also very tiny at the moment. However, okay, I could forgive you for saying, well, if he's going to focus on these last two areas, that's not really relevant today. But I think it's very relevant going forward, right? Because the reforms of the last few years have put more and more emphasis on the private role and the individual role in building resources for retirement. And while today those resources are low, prospectively, they become much more like the US defined contribution pension system. And consequently, I hope that some of the lessons from that system will be of interest as we talk through the way in which retirement security is handled in different settings. Okay, so keeping this picture in mind, what I'd like to do is to show you now what the US pattern looks like. Okay, and I'm going to do that in two ways. I'm going to start with information on the households, and then I'm going to look at the aggregates and give you a sense of how this all adds up. Okay, so the first thing to show is what the micro data on household balance sheets looks like for saving behavior in the United States. I'm looking at households who are in their late 60s. These are mostly going to be retired households. The labor force participation rate for the late 60s in the United States is down in the 20% range. So most of these households will be out of the labor force. And the first column is what we call Social Security wealth. That is the first pillar. That is the government provided basic pension. And I have tried in this column to calculate a rough annuity, a rough capitalized value of the benefits that retirees would expect to receive. What you see is that for a household around the median of Social Security receipt, this is a few years ago. The numbers would be higher today because interest rates are lower. But a few years ago, the median household in this age group would expect to have about $250,000 of Social Security wealth accumulated. And that is, of course, just the result of the government programs that they are eligible for. For the median, looking across the slide, what you see is that is much larger than any of the other components. And even the 90th percentile, you know, it's a large variation, a fraction of 4, but there isn't a very, very large top end to this. Compare that with the second column, which is defined benefit pension wealth. This is employer provided pension annuities that are for more than half of the households irrelevant for their retirement security, but for half of the, for about 35% of the households do matter. And there's a lot of variation, okay, from 0 to numbers that are often on the same order of magnitude as Social Security at the top end. Okay? And then finally, the third column is Pillar 3. It's the savings in what are called individual retirement accounts and defined contribution pension plans. These are individually contributed accounts in which the individuals, like in Pillar 3 that is emerging in China, have been saving and accumulating their wealth. And here what you see is that at the median, this is for the median household, you know, in this category, the accumulation is actually quite small, but the top end is very large. And one consequence of relying on something like a voluntary structure is that those who contribute frequently and contribute a lot will end up with very large balances potentially at retirement. And that is exactly what we see. So greater inequality is one of the features that comes along with the reliance on the voluntary pillar 3. One can think about, and it's an important design question, how much to limit the contributions to pillar 3 accounts. And as I mentioned, they're often accompanied by some sort of special tax relief. When that is the case, there's a question that's a garden variety public finance trade-off between how much revenue to lose by encouraging this type of saving and how much additional retirement security is obtained by doing that. And I may come back and say a little bit more about that later on. All right, but the important thing is to give you some sense of where the US is relative to the Chinese system today, which is in columns 2 and 3, pillars 2 and 3, there are, for some households at least, quite substantial resources that have been accumulated and that will support their retirements as a result of the activities on those plans. Okay, let me now show you the aggregate of the total value of the pension commitments. And what I've done here is to look at data on the real value of defined contribution. These are the various, either voluntary or in some cases employer contributing to a defined contribution plan, versus the traditional pension, the defined benefit plan, which is the orange line on the graph. And I should make sure just to set the stage and nomenclature and naming for these for everyone. For those who are not experts on the pension literature, a defined contribution plan is one where the commitment is on the amount contributed to the plan every year, but the balance that will be available at retirement to support retirement lifestyle is a function of the returns that are earned on that balance between the contribution date and the retirement date. A defined benefit plan, what I might call a traditional pension plan, and what is closer to what we see in Pillar 1, is a plan which basically promises a benefit for the worker at retirement. It therefore defines the benefit that will be received. But of course, if I am supposed to provide as an employer or as a government a specified benefit stream after retirement for a worker, and I have to accumulate the resources to fund that liability, okay, I then bear very substantial risk. So a key question in thinking about pension design, and one of the reasons I wanted to talk with you about this tonight is because I am so enthusiastic about the research opportunities in this area, because they all fundamentally involve the public economics of risk sharing and incentive creation and of the trade-offs between risk bearing in the public and the private sector. The key difference between the defined contribution and the defined benefit programs of pension defined contribution side, it is typically the worker who is bearing the risk. In the defined benefit plans, it is the employer who bears the risk of trying to fund those liabilities as they go forward. Okay, so that's the key difference that we want to recognize. Let me then just show you the transformation in the United States over the last 45 years. If I had been giving this talk in the early 1980s, when it first became possible for North American academics to visit China, I would have been focusing on these defined contribution plans as just a minor part of the retirement security landscape, right? With the defined benefit programs, the vast majority of what's there. But over that 40-year period, there's been a really significant transformation. And today, much more than half of the assets and more than half of the pension promises associated with the US system represent defined contribution plans, which are in this voluntary contribution structure. Okay, and to give you one more bit of motivation, this gives you some idea of the sets in defined contribution plans in the United States. Okay, rising to today roughly equal to 1 year's GDP, about $20 trillion. And defined benefit plans by comparison have been about, the total value of the benefits promised is on the order of 60 or 70% of GDP through most of the period we see. Okay, so again, I think the motivation here is that China may be embarking on a transformation of the retirement security system that view showing you here, which is the growth of the private sector defined contribution type structures. And therefore, there may be opportunities to learn from the experience of those structures in the US as we think about the system going forward in China. Okay, so having set the stage with that, most of the rest of my talk will focus on pillar 3, these voluntary accounts, which are more important in the United States than they currently are in China. And I'm going to just sort of try to highlight the implications of very low rates of return, at least those are, in terms of what's available today in the North American capital markets, for the accumulation in a pillar 3 type account. And to start this analysis, 3 things that will determine the amount of wealth at retirement in a pillar 3 account. The lifetime earnings trajectory of the saver, the fraction of earnings that they save year by year, and the rate of return they earn on whatever they have contributed to those accounts. Okay, so where is the impact of the change in rates of return, the zero interest rate that we are seeing today in many places in the Western world? It's on the rate of return, right? And it's all going to come here. So what I'm going to focus on is just highlighting how the decline in the rate of return matters for the accumulation prospects. And then, of course, a natural question will be, well, what does that mean for lifetime earnings or for the fraction saved? And we'll talk about all of those questions as we go. So let me now take a detour into financial economics for just a moment. And with scholars like Zhigo on the line, I will defer on some of these core issues of finance. But this chart just shows you the 10-year nominal interest rate on US Treasuries, which are traditionally viewed as a very safe asset. And 25 years ago, were yielding about 6%, 600 basis points, and today are well below 1% at around 0.6 of 1 percentage point as a yield. Okay. Now we will of course say, well, this is a nominal yield. What really matters for savings accumulation is a real return, and I agree with that. And the next slide will show you the 30-year inflation index bond in the US. We have these Treasury inflation index securities, inflation protection securities, and today the yield on a Treasury inflation-proof bond that matures in about a decade is around -1%. Even 30 years out, it looks like it's negative, suggesting that to get inflation-proof income in a relatively riskless way, savers today are expecting to give up part of their principal over the course of the next 30 years. Okay, this chart, while it's part of the motivation for my calculations to come, is frankly an absolutely astonishing one, I think. If we just go back and think about our principles of economics and the supply and demand for savings and loanable funds, the notion that the equilibrium in the long-term riskless rate market is clearing at a negative value is really an extraordinary development, and one with implications for public finance as well as many other places. If you look at the negative yields here for the U.S., the U.S. is actually a high interest rate country by some of our Western standards. This chart just shows you the term structure of real interest rates for inflation index bonds in the United States, the UK, and Germany. The blue line is the US. You see that that kind of varies from about minus 120 basis points in the very near term up to a return of about minus 40 basis points at the 30-year bond. In Germany, the term structure goes the other way, but 30-year bonds that are inflation protected are yielding about minus 150 basis points. And in the UK, it's an extraordinary minus 250 basis points. So, you know, this set of developments, right? The fact that in capital markets, it appears as though market participants are prepared to accept declines in the real value of their investments in order to obtain a safe payout in 20 or 30 years is something which stands on its head. Much of the traditional analysis, the traditional discounting and other things that we do. And it's the motivation for what I'm going to show you in just a second. Okay. Now, you might say, and you would be right to say, but do retirement savers hold only inflation index bonds? You know, they have a diversified portfolio and they're not going to earn these kinds of low returns. They'll do better than this because they will bear some risk. Okay, and that comment is fair. If one looks at the expected real return on stocks in the U.S. Now, you know, measuring riskless interest rates is a very easy thing to do when we have the term structures I've just showed you. There's no guarantee that those rates are going to turn out to be what investors earn over the next 30 years, but at least we know what the market is expecting. Much harder to do in equity markets because we don't have an easy way of backing out the market's expected return. We have some things which give us some guidance, like the earnings price ratio or the dividend price ratio, but we do know that expectations of gains can be very important in the equity markets. The calculation I'm showing you here is taken from some survey evidence. It's a survey done by the Federal Reserve Bank of Philadelphia that asks professional forecasters both what they expect the nominal return on the S&P 500, a broad measure of the US equity market, to be for the next 10 years. And it also asks them what they expect inflation to be. And I have simply taken the difference between those two and called that the real expected stock return. And what you of course see here is that real expected return 20 years ago was a number around 5%. That number today is a bit lower than 3%. So, you know, the reason I show you this is because if we are trying to think about the portfolio that a retirement saver might hold, which would include some stocks, some equity, you know, some bonds, if the return on bonds has come down, but the return on equities has stayed the same, or, you know, conceivably, the equity risk premium could have expanded. So equity expected returns could have even gone up as riskless returns went down. Those developments could counterbalance the kind of effects of declining real rates that I've showed you up above. But at least I think that the evidence here suggests that, you know, on first pass, it looks like as real interest rates have come down, the real expected stock return has come down as well, which is consistent with a roughly constant equity risk premium, and certainly does not provide any strong evidence that the equity risk premium has expanded at the time when the real interest rate has fallen. So I think that the data seem to suggest a general period of low expected returns, whether that's on bonds or on stocks, and consequently that there will be some period over which the markets at least seem to expect lower opportunities for earning returns in investments, whether they be in retirement accounts or elsewhere. And I should pause here for a moment and say that I think one of the key questions I hope we can come back and discuss is how this type of market-determined rate of return framework translates to the Chinese context, right? Because I know that Chinese interest rates are, by comparison, still much higher than those that we observe in the US or in Europe. I also know that the credit markets are more tightly regulated and that the role of market clearing prices here may be somewhat different than it is in the capital markets that I am pointing to here. So figuring out exactly how to extract what the developments in Western capital markets are doing in terms of implications for returns in the Chinese economy and for Chinese savers is very much a priority that I hope we can discuss and I can learn a bit about from the group that's on the call tonight. All right, well, let me now move on to just to give you one other sort of piece of comparison. This is to show you the rough accumulation profile, the rough accumulation environment that characterized the 20 or 30 years during which I showed you the rise of defined contribution type accounts in the US. What you can see is that historically, going back, say, 30 years, the real interest rate on 10-year treasuries was about 2.5%. The real return on the S&P 500, about 7.5%. Go back 40 years, they're both a little bit higher. Okay, so in some sense, you should be thinking of the difference between the numbers in those charts that I showed you, which are basically negative on the real interest rate, and numbers on the order of maybe 2.5 or 3% on stocks, versus the numbers that are in this chart. And that's a measure in some sense of the gap in the return, which if current expectations play out, current savers may be facing relative to the savers of 30 or 40 years ago as they were trying to accumulate retirement assets in the defined contribution system. Now, I should say, there are multiple explanations of what's going on in the Western capital markets. And there are leading economists, very distinguished scholars, are propounding different potential explanations of what's happening. Ben Bernanke has talked about a global savings glut and essentially just a simple supply demand. There's a lot of supply of savings and therefore the equilibrium return to the savers is very low. Ricardo Caballero, my colleague at MIT, has discussed the possibility that there is a scarcity of safe assets, that many investor categories are particularly interested in holding essentially riskless assets, and that as a consequence, the equilibrium returns for assets like US Treasuries, inflation indexed or otherwise, have become very low. A third possibility is that some of this is more inside the diversification aspects of the things financial economic studies, that it was the case 20 or 30 years ago, that treasury bonds tended to co-vary in their returns positively with stock returns, and that today they have begun to move in different directions. As a result of the fact that treasury bonds are now a better hedge, there's more demand for them, and consequently the equilibrium return has declined. Okay, and my suspicion is that there is some truth to all of these explanations, and it's not my point this morning to try to sort them out, but rather just to say, whatever it is, we are in an environment of very low returns, and what are the consequences of that for the provision of retirement security? Okay, so to take you, down that path, there are basically three things that happen when we move into a low return environment like the one we seem to face now. Right, the first is that the low returns make it more difficult to accumulate assets for a retirement saver who is trying to build up a fund for retirement. The second is that the low returns reduce the payout that can be expected in retirement from whatever assets may be accumulated. And I will focus in my discussion on annuities as a way of framing the nature of that payout. But the same principle would be true for an investor who was not purchasing an insurance product like an annuity, but rather just hoping to live on the income of their portfolio. Effectively, what I'm telling you in bullets 1 and 2 is, when you think about the optimal stochastic lifetime consumption problem, and you lower the rate of return, that changes things throughout the career. Okay, if you follow the same savings rule in a low return world as in a high return world, you would no longer be on your optimal consumption path, and you would end up discovering that you saved less for retirement than you would have done in a higher return equilibrium. Okay, and finally, the point that I'll mention, but only briefly, is that when the return declines, I think there's some evidence that that may shift retirees away from annuity type products, which provide them with longevity insurance, and it may shift them toward just holding on to their assets, and that may have some implications for the risk bearing that takes place in late life in various ways. Okay, so I just like to do a numerical example basically with you to show you and illustrate the consequences of accumulation in this low return setting. Okay, so I want you to think about a worker. The worker has earnings which grow at 1% real each year, and I normalize their earnings to be 1 at age 65. I am interested in calculating the wealth of this worker retirement wealth at age 65. I want to recognize that if that worker makes that contribution at age A, the amount that they will have when they reach age 65 is going to be the rate of return, 1 plus R, to 65 minus A, right? And in addition, so that's the numerator, that's the assets they've now got. But I'm dividing that by their earnings at retirement. Okay, and since their earnings are growing at 1% a year, okay, when they made the contribution years ago at age A, their earnings, normalized, remember, to be 1 at 65, are 1 over 1.01 to the 65 minus A years smaller than they are at age 65. So I need to recognize that my earnings are smaller and earlier in life, and when I make that smaller contribution, 1% of my smaller salary, it grows at a rate of return R, and then I have at age 65, the age that I think I will retire at, the balance associated with that account. Okay. Notice that if I save 1% of my earnings every year, beginning at some arbitrary age, the amount that I have at retirement is then just the sum of between age 65 minus T, which is when I begin to save, and age 65. And I'm doing this all, and I confess, since this is a public finance seminar, I'm doing this all in a pre-tax environment, and that corresponds to the way, at least in the US and Canada and the UK, that is the way these retirement accounts work, which is that there's no taxation on these accounts until the beneficiary reaches retirement, and then the income which is pulled out of these accounts is taxable at that point. Okay, and we can come back if there's interest in the questions to talk about different strategies for providing those kind of tax incentives. Okay, if I have a saver who is contributing 1% of his or her salary every year for 20, 30, or 40 years, how much will they accumulate over the course of their saving career? Okay, think about for a moment the middle column here, the real interest rate of 1%, because that's the easiest to see what's going on. Okay, in that setting, okay, if you save for 30 years, and if the interest rate's 1% real, and if your wage is rising by 1% each year, then the return on the investments you made just compensates for the increase in your wage. So that 30 years of savings at 1% of savings of earnings a year gives you 30% of your final salary when you get to age 65. Okay, same thing's true for 20 years and 40 years, and this kind of drives home and gets the intuition for what's happening. If I move to a 3% interest rate world, and I do the same thing, I save for 30 years, and now I end up, okay, even though I'm saving 1% a year, I actually end up with 40% of my final salary instead of 30. And that, of course, is just the power of compound interest. We know that compound interest is more important over longer horizons and at higher rates of return. And you see that, for example, if you save for 40 years, the ratio of the 1% to the 3% is smaller. In other words, you get even more bang for the savings that you're doing with a 40-year horizon. Okay. If I now go to the zero interest rate world, what you discover is that I actually have, even though I've saved 1% of my salary every year, okay, if I do that for 30 years, I only have 26% of my final salary accumulated. And that's of course because my wages have been growing, but the value of my savings has not been appreciating, and consequently I've fallen behind on my salary. Okay, so this is the first piece of what I want to illustrate, right? It's not it shouldn't be particularly surprising to show that when interest rates are lower, or rates of return are lower, it is harder to accumulate wealth. Okay. The second thing I want to do though is I want to translate this wealth accumulation into what level of income can be supported in retirement. Okay, and this is where I want to dive into the insurance market for a moment and talk about the annuity market that operates in the United States. Okay, and the particular annuity I want to describe for you is something called a single premium immediate annuity, SPIA. Okay, and it is basically the textbook annuity contract that one would envision. Okay, remember, an annuity is effectively a reverse life insurance contract. With life insurance, each year you make a payment to the insurance company. When you die, the insurance company makes a much larger payment to your beneficiary. With an annuity contract, you give the insurance company a large pool of assets at the beginning. They promise to deliver an income stream every year for as long as you're alive. When you die, the benefits stop, and the insurance company gets to keep whatever assets are left over. Okay, what does it cost to get that kind of insurance? What does that kind of product cost at the moment? So these are data from last month, from July of 2020, in the United States insurance market, and they give you some rough idea of what these annuities would pay. So if a 65-year-old male brings $100,000 to the insurance company and wants to buy an annuity policy, the insurance company on average will offer a payout of about $5,700 per year, right? So this is basically about a 5.5% payout on your annuity purchase. Now, there are different flavors of annuities to purchase. You might, for example, say you'd like the payout to increase over time, not in an inflation indexed way, but a 3% a year nominal increase. That, of course, means that you are going to get a larger benefit stream out in the future, and the insurance company will give you less today if that's the benefit stream you've chosen, significantly less. Instead of $5,700, you'll be getting $4,100 per year. Another kind of contract says, I want the insurance company to pay me for at least 20 years. And if I die before 20 years, I want that payment to be made to my beneficiaries, to my heirs. That contract also will give you less money starting out, okay, but not as much as the 3% escalator. The 20-year certain, remember, the only value that's created for the participant there is in the cases where you wouldn't have lived 20 years anyway. What you see is that additional burden put on the insurance company reduces your payout from about $5,700 to $5,200 per year. You can see that for women buying the same type of policy, women have longer life expectancies, and consequently they get less payment if they purchase an annuity. And then the last row shows something called joint and survivor annuities. These are basically policies that are purchased by typically married couples, which are going to continue to pay until the second of the two members of the couple dies. That, of course, means a significantly longer expected payment period for the insurance company, and it means a significantly lower benefit payout for the annuitant at the beginning of the payment period. Okay, so what these policy prices, right, the amount that you can get as a payment, give you some idea of the workings of this annuity market. And if you think about the basic economics of an annuity, what can the insurance company offer to pay in a competitive marketplace to the person who buys the annuity? Well, the insurance company is going to earn a rate of return on the assets that you give them to invest, or the insurance company has each year a probability that you will die and that they will get to keep the principal that you have invested with them. Okay, call that probability P. Okay, well, if P was constant over all the years when the annuitant was collecting benefits, the insurance company could agree to pay out R, the rate of return, plus P, the probability they get to keep the principal every year. And that's essentially the break-even condition for annuity pricing. So when interest rates fall, what has to happen is that the annuity payout has to decline. Okay? And this chart shows the yield in black on a high-grade corporate bond in the United States, and the average payout, in this case monthly, on a $100,000 annuity purchase by a 65-year-old man. And what you see is they almost move in lockstep, right? They move very closely together, and it's just telling you that the rate of return declining, the nominal rate of return in the annuity in the bond market declining, translates into a decline in the nominal payout that the annuity can offer. And I mentioned earlier that I think that one of the additional effects of these low returns on retirement security may be that annuities look somewhat less attractive. I should, by the way, mention at this juncture that my affiliation on the front showed something called TIAA. And TIAA is an insurance company which sells annuities to academics in the United States, and I serve as a trustee there. So I just want to flag that whenever I'm talking about annuity markets. Okay? But what may happen here is that the annuity market may look more expensive to a potential annuity buyer because the payout you're going to get per $100,000 of investment is now a lot lower than it was. And even over the last year in the United States, these annuity payouts have fallen in some sense on the order of 10% of what those payouts would have been. So that I suspect will actually drive people away from annuities as we think about the path going forward. All right, well, let me now what I want to do is to use this annuity structure, and I want to connect it with what I showed you in the accumulation stage to talk about the implications for what people can actually accumulate. Okay, so in this table, okay, what I've done is to say, remember that people were accumulating like this, right, according to the rules that I've got here. Think about the 1% of salary that they're contributing each year, and now buy them an annuity when they get to retirement and see what's going to be their payout, right? See how much they will have in terms of their stream of income in retirement relative to what they would have had as an earnings stream at the last year that they were working, okay? So I've assumed that the annuity that is available for them to purchase, okay, is priced at a 4.5% a year mortality rate plus the rate of return that's the real interest rate in my assumed calculations, okay? 4.5% mortality rate translates into a life expectancy of a little bit over 20 years at age 65. That's in the ballpark of what would be typical for US men today, okay? So now look at the calculations, start again with the 1% interest rate case. If for 30 years, you saved 1% of your earnings every year, and you accumulated that balance, and at retirement at age 65, you purchased an annuity with the balance that you had, each 1% that you saved would translate into a 1.7% of your salary payout when you were retired, okay? So remember that 30 years at 1%, you've got 30% of your salary. This says you take 30% of your salary and you get 1.7 divided by 30, so something that's on the order of 5.5 to 6% of return paid out when you are in retirement, 5.5% exactly. Okay, you do it for 40 years at a 1% rate of return. For every 1% of earnings you save, you get 2.2% of your final year's salary. Compare that with what happens with the interest rates 3%, right? It's a very different story. Your payout is twice as great in a 40-year setting, almost twice as great in a 30-year setting. And the reason is that you've got the compounding giving you a larger balance at retirement, plus you've got the higher payout on the annuity when you actually make the purchase of that annuity in retirement. In the 1% column, the annuity is paying you 5.5% each year per each dollar you invest. In the 3% column, it's paying you 7.5%. And that, of course, means a big difference in terms of the payout stream you can expect, okay? Notice that in the zero interest rate case, these numbers are smaller still, right? And the difference between a 3 and a 0% real interest rate is a difference of a factor of 3 in the amount of retirement income that you can receive per percentage of your salary that you saved while you were working. Okay. So these numbers are stark differences. Now, and I think I want to caution before we leave this table, they are probably too stark, right? In the sense that it may not turn out that for the entire time, 40 years that somebody is saving for retirement, the rates of return will be the returns that we see in the capital markets today, okay? And it may turn out that they can invest in equities, and that brings these numbers up to higher values. And that's important because a 3 percentage point drop in the return makes a smaller difference when you do it from, say, 8% to 5% than when you do it from 3% to 0. Things get particularly stark down here. You would not end up with these very tiny numbers if you were doing it at a higher level, even though the compounding at that extra high rate actually gives you some really exciting returns. But the key message here is just, it's going to be harder for retirement savers to accumulate assets if they are facing rates of return like the ones that I highlighted at the start of the talk. So what does this translate into in terms of savings rates? Well, say you were a household or an individual hoping to save 50% of your final earnings and replace that earnings with an annuity when you reached retirement. If you were going to save for 30 years and the interest rate was 1%, you would have to save 30% of your salary every year to be able to accomplish that. In a 40-year horizon, you'd have to save 22%. And if you manage to get a higher return draw, right, 3% would actually replace 50% of your final earnings. Now, I know that the United States and China have very different savings rates. In the US, someone saving 11% of their salary is saving a lot. In China, I know there are those who save much higher numbers. But for a country like the US, the move to these low rates of return is going to present some very real challenges for private sector retirement accumulation. And I should say there's nothing particular about the individual saving through Pillar 3 that is making this complicated, because the same problems arise for a company trying to provide Pillar 2 income through an employer scheme, whether it's an occupational or an employer type annuity that's being offered, because the accumulation part of those plans gets much more difficult as one looks to the low rate of return environment. Okay, so let me now ask what the implications are. You know, what I've showed you is in some sense just arithmetic with a little bit of compounding thrown in. What are the ways in which one might respond to this low return environment? And there are at least three different things in the private sector that one could think about. Okay, so in Pillar 2 or in Pillar 3, you could raise savings rates. The individuals can contribute more, or the employers could contribute more in Pillar 2. Okay, individuals could work longer. Okay, basically having a longer time to accumulate, whether that money is being contributed by the employer or by themselves in Pillar 2 or Pillar 3. And working longer has a double-edged impact on retirement security, because it gives you more years to save, and it gives you fewer years to provide for in retirement. So each additional year, you give one more year of contributions and take one more year off the retirement years. And that's very important. And the third thing people could do is they could reach for yield. They could try to basically take on riskier investments and hope that the returns they earned were going to be higher. And I don't think there's evidence of any of these three things happening very much. We've seen line in at least the real riskless rates that I showed you. Okay, and over the course of certainly the last decade or decade and a half, the personal saving rate in the U.S. has been pretty constant in this range of 6 to 8%, bouncing around a lot, but nothing that looks like we've seen a sharp uptick there. And over the longer haul, savings rates have actually come down. Working longer, there is actually evidence of some increase in labor force participation. For men, participation rate for men is now about 35%. For women, it's a bit lower. It's in the high 20s. And we see that in the U.S. at least, there has been a general upward trend in labor force activity at older ages for nearly 30 years now. So that, of course, is contributing. It is helping those who can contribute to work longer, continue to work longer, can build a larger asset base for their retirement. But this is still affecting only a small fraction of the population. If you think about moving from 25% here to 35% here as the group that might be jumping in to work longer. Reaching for yield, this chart, which may be a little difficult to read the detail on, is showing you the way in which the funds that are held in retirement accounts, those Pillar 3 accounts in the US, are invested by different asset classes. Equity mutual funds, stock in the company that the worker is employed by, some combination of stock and bond funds, all bond funds, some sort of bond type in valuation. The only thing that looks like it changes very much over the period, this is from 2007 to 2016, is it looks as though these balanced funds have increased from about 15% to about 27% of the total, somewhat offset by a decline in company stock of about 5% and a bit of a decline in these stable value vehicles over here. Okay, but basically the equity share has not changed very much over the time we see, and to a large degree looks pretty stable over what we were observing. So I don't think any of these three mechanisms is being actively used across the board as a response. I think that means, unfortunately, that it is going to be somewhat challenging for those who are currently in their saving years to build up asset balances that are as large as the ones that they see their earlier generations having accumulated, and we'll have to see whether that results over time in much higher saving rates or other responses. Okay, I should say, and it's very important because this is a public finance group. This last bullet on the adaptation strategies strikes me as absolutely central for the public economics aspect of this, which is what about intergenerational risk sharing? So the story one would tell is the generations that are saving today for retirement have just been hit by a negative shock, just as being an employee during a pandemic may be a negative shock, or being a generation which lives through a time when there's a world war is a negative shock. And there's no particularly effective way in a Pillar 1, in a Pillar 3 or a Pillar 2 account to transfer resources across generations. But a Pillar 1 account, the government social security, the government basic pension, because it can be financed by taxes and debt can enable us to move the funding across generations, there is a real possibility of risk sharing there across generations. Okay, and that can come in the form of, we've seen examples in the United States. There was very substantial transfer to the generation that was alive, beginning that was alive and hit their retirement ages in the 1940s and 50s and 60s. They were substantial beneficiaries of a social security program which gave them back much more than they contributed. And that was funded effectively by taxing the future generations to pay for those benefits. In a pay-as-you-go social security system with rapid population growth or rapid productivity growth and earnings growth, one can accomplish those kinds of transfers. But in a world of lower growth, in a world of lower returns, those transfers become much more expensive. Okay, so what I view as a really important part of the research agenda in this area is thinking about risk sharing within each of these different pillars and what is allowed, okay, or what is possible. Okay, in Pillar 1, we can have both within cohort and across cohort redistribution. Okay, and I don't know the details of the China system, but in the US, we do have substantial redistribution within the cohorts. This chart just shows the replacement rate for career average earnings for individuals under the Social Security system in the US today. And what you can see is that for someone who retires, this NRA is the normal retirement age for retirement under Social Security. Today, that's about 66.5 years. Someone who was very low in the earnings distribution would receive benefits equal to about 2/3 of their salary. Someone high in the distribution would receive something on the order of 1/4 to 1/3. So there's substantial progressivity in the Social Security system as it currently operates. That transfer basically operates to bring up the bottom of the distribution and serves as a very important anti-poverty program for elderly individuals. But that's the within cohort distribution. Social Security, as I said, also offers you a chance at intergenerational redistribution. Pillar 2 can allow within firm redistribution, right? A firm could decide to have larger contributions for its lower paid workers relative to their salary. Pillar 3 is the one that permits the least risk sharing over time, because it is typically, in traditional settings, it is basically the individual bearing the risk of the accumulation of the contributions they have put in. They are essentially on the hook for the capital market risks that they will face. And the risk, the question of who should bear these risks is, I think, one where public policy has a great role to play. One of the reasons I find this area so interesting at the moment is we are now seeing the emergence of alternatives to pillars 1, 2, and 3, which are hybrids that bring in different kinds of risk sharing. So, for example, notional defined contribution plans, which essentially promise a beneficiary a benefit when they reach retirement, but don't actually fund that along the way, but may make that benefit somewhat sensitive to the risks that are experienced. So it's a notional contribution or a target benefit, but there may be some kind of risk sharing between the employer or the government and the beneficiary. Collective defined contribution plans, which are being tried in Canada, in the Netherlands, and now in the UK, where effectively individuals contribute into a common pool of defined contribution assets, and then the collected returns are smoothly allocated across individuals so that a 65-year-old about to retire is not fully bearing the cost of a capital market decline as they approach retirement, but rather is sharing some of that with the younger workers in the firm in a sort of in what amounts in some sense to an across cohort redistribution. Okay, the key challenge in all of this is trying to provide the insurance for the capital market shocks at an affordable cost. And I think as one looks back to my earliest slides on the shift from defined benefit plans to defined contribution plans in the United States, a very big part of that shift, I believe, is attributable to the fact that employers concluded that it was simply too risky to promise a defined benefit or guarantee to their workers because the risks in terms of generating that fell on the employer. And one of the consequences of a decline in returns like what we've just seen, okay, and this is a consequence for Pillar 1, think about the valuation of a stream of benefits that I have promised. If I tell you I will pay you a riskless, inflation indexed stream of benefits starting at age 65, $15,000 a year, okay, and I promise that to you, and that is something very much like what Social Security in the United States promises for a middle range beneficiary. If the rate of return is 1% per year, the real rate, the value of that stream is about $264,000. Okay, if the real rate is minus 1% for the next 25 years, the value of that stream is significantly greater. Okay, it's about $330,000. Well, what does that tell you? It tells you that at the very same time, the challenges of saving in a Pillar 3 account have gotten greater. The real value of a Pillar 1 promise from the government has gone up. Okay? Well, then the question is, how does the government fund that greater promise, right? If the government were to try to fund it by investing in capital markets today, it can't do anything different than what I've just shown you in terms of these low rates of return. So we end up with this problem of trying to figure out how do you fund this. And if the low real interest rate, and this is where I verge on a little bit of macro for a moment, if the low real interest rate is a signal of expectations of low productivity growth or low economic growth more generally, right, that's an indication that there may be a challenge of funding, even in a pay-as-you-go social security system, that will be greater going forward than it was in the past. Okay. So I'm going to stop in just a minute or two because I want to make sure we have time for some questions. Let me share one more thing with you because I'm a bit of a, I really am fascinated by demography and the underlying mortality tables and related calculations which are so central to Social Security and pension provision. But I want to share one more thing about changes that have taken place in the United States in mortality rates over the last few decades, because they speak, I think, to the question of who is likely to bear the key burden of the savings brunt that we just talked about. Okay, so life expectancy has increased rapidly in both the U.S. and in China in recent decades. It is projected to continue to increase in both, with the absolute gains in China much larger over the course of the next few decades than the gains in the U.S. That largely reflects the fact, looking here at age 65, that China today still has life expectancies which are somewhat lower than the United States, but getting toward more convergence as we go out toward the future. Okay? The improvements in life expectancy have not been equally distributed in the population in the US. Okay? And this chart shows you the life expectancy for a man at age 65, for men who were born in different years, and for men who were in the upper and the lower half of the earnings distribution in terms of lifetime earnings. Okay, in 1912, the first of the years that I show, the difference between life expectancy for the top half and the bottom half of the distribution was less than a year, okay, closer to half a year. And as you can see, both of the life expectancies were relatively low by modern standards. They were about 15.5 years. Over the course of the next 30 years, okay, moving out to men who were born in 1941, men who today would be about 80 years old, okay, what we see is that life expectancy for those whose earnings over the course of their career was in the bottom half of the distribution, increased by about 1 year. Life expectancy for those who were in the top half of the distribution increased by almost 7 years. Okay? And this dramatic divide, with the higher earners experiencing greater health gains and greater life expectancy gains, is consequential as we think about the burdens of saving for a longer lifetime, right? Because the groups that are going to face particularly long lives are the groups that are in the upper part of the distribution. They are also the groups, if you think back to that slide that I showed you at the very beginning of the way in which retirement is financed, they are the groups that rely the least on Pillar 1 and the most on Pillars 2 and 3. So while you might say, well, these are the upper half of the distribution, don't they have the resources to be able to provide for this? The answer to that is partly yes, but it is also that they are in some sense being faced with a double challenge, which is longer life expectancies. At the same time, they are facing lower rates of return. So let me conclude. The low capital market returns that we are experiencing in Western capital markets today represent a very important challenge for funded retirement systems, whether they're funded by firms, funded by individuals. It is really hard to accumulate when the rate of return is as low as it is in fixed income markets today. The aging population that we have in both China and the United States, slowing productivity and wage growth, is a challenge for the government-provided pay-go systems because they, of course, depend critically not so much on the capital market rate of return, but what my late colleague Paul Samuelson in his work on the overlapping generation model called the biological rate of return, the population growth which enables you to support an old population using a much larger young population That, of course, doesn't work very well when the population growth is stable. And finally, and particularly for the students who are with us this morning, the sharing of tax burdens and the sharing of risks are absolutely central public finance questions that we are going to be facing for coming decades. And I think that the field of public finance, as well as the field of financial economics, right, two fields which have not connected as much as I would like them to in the last few decades, share tremendous opportunities in working on these issues, right? And I think we need to bring the insights from financial economics and the tools of not just insurance, but of risk bearing through capital markets to bear on these questions, and to think in a way that goes back to Arrow and Lind and others of the tax system as a way of essentially sharing risk, just as capital markets are a way of sharing risk. And to ask the question, how do we optimally want to share the risks that are faced as we think about retirement security in countries like China and the United States?